Merry Christmas again, but this message is an emergency, because critical data from Asia just shattered a core assumption about how global silver markets are supposed to function. I tried to ignore the markets today, but what crossed my desk forces us to pause celebrations and examine a structural fracture forming inside the global financial system. This is not a prediction or chart pattern, but a verified price signal coming directly from the physical silver market in China. Right now, physical silver in Shanghai is trading at a price so extreme that it invalidates the paper pricing model used in New York. The number you are about to see is real, confirmed, and deeply unsettling for anyone who believes global arbitrage still works. As of the latest settlement, the Shanghai Futures Exchange is pricing silver near $80 per ounce. At the same moment, traders in the United States are being shown a paper price near $71 per ounce. That difference is not a normal spread, not volatility, and not speculation, but evidence of a broken pricing mechanism. In healthy markets, such gaps vanish instantly through arbitrage, as capital flows to exploit even tiny inefficiencies. Yet this gap is growing, not shrinking, which tells us something critical has failed beneath the surface. To remove any doubt, we can convert the Shanghai price step by step using official exchange rates and standard silver measurements. When the math is completed, the result confirms an enormous premium being paid for immediate physical silver in China. This means the world's largest manufacturing economy values real metal far more than the paper promises traded in New York. Such a divergence can only exist if the metal needed to close the gap cannot be sourced or transported. Banks, hedge funds, and algorithms should be exploiting this difference instantly, yet none of them are. That silence is the warning, because it implies the silver simply is not available where the paper claims it exists. What we are witnessing is the early stage of a physical market divorce from its paper price. This kind of disconnect historically appears only before major repricing events in commodity markets. With Western markets entering a low liquidity holiday period, the timing of this signal becomes especially dangerous. The question now is not whether the gap will close, but how violently the adjustment will occur. To understand why this gap exists, we must examine arbitrage, the invisible force that normally keeps global commodity prices tightly aligned. Arbitrage works only when metal can freely move from where it is cheap to where it is expensive. In silver, this means buying futures in New York, taking delivery, shipping the bars, and selling them in Asia. Under normal conditions, even a $1 difference would trigger massive institutional buying. A $9 premium should create a global feeding frenzy among banks and hedge funds. The fact that it has not tells us arbitrage is no longer physically possible. Either the silver does not exist in Western vaults, or it cannot be mobilized fast enough. This transforms the price gap from an opportunity into a warning signal. When arbitrage breaks, paper prices lose their authority. Markets then begin searching for truth through violent repricing. China's role is central because it is not speculating, but consuming silver at scale. Silver is not money in China's factories, it is a production input. Solar panels, electric vehicles, and advanced electronics require immediate physical supply. When factories lack silver, production stops entirely. That reality makes price secondary to availability. Chinese buyers are therefore willing to pay any premium to secure metal today. This behavior explains why the Shanghai price is detached from Western paper markets. The East is pricing survival, while the West is pricing derivatives. This difference in motivation is now tearing the market in half. And once physical demand dominates, paper pricing mechanisms collapse rapidly. The first engine driving this physical demand shock is China's solar manufacturing industry, which dominates global photovoltaic production at unprecedented scale. For years, analysts believed solar companies would reduce silver usage through efficiency gains and material substitution. That assumption has now failed as manufacturers hit a hard physical limit in silver reduction. Recent industry data shows silver consumption per watt has stopped declining despite rising prices. This means future solar growth requires more total silver, not less. At the same time, panel technology is shifting toward higher efficiency designs that consume significantly more silver. New cell architectures require between 50 and 80% more silver than legacy designs. This shift is happening while global silver mine supply remains flat. The result is a structural imbalance that cannot be resolved by price suppression. Chinese solar manufacturers understand this reality and are acting preemptively. Instead of waiting for refiners, factories are sourcing silver directly from exchange warehouses. Investment-grade bars are being melted down to feed industrial production lines. This behavior signals desperation rather than speculation. Companies are securing inventory today to survive shortages tomorrow. The solar sector alone would be enough to strain global silver supply. But it is not the only source of demand pressure. A second, even more powerful force is emerging from the electric vehicle industry. Battery technology breakthroughs are rewriting silver demand assumptions overnight. This new demand is strategic, long-term, and price insensitive. Together, solar and electric vehicles are overwhelming the existing supply system. The electric vehicle shock accelerates this crisis because battery technology is evolving faster than supply chains can adapt. Traditional electric vehicles use small amounts of silver for wiring, contacts, and control systems. New solid-state battery designs dramatically increase silver requirements per vehicle. Some next-generation batteries require up to 1 kilogram of silver for a single car. That represents a 20 to 50 times increase in silver consumption per vehicle. China, as the world's largest electric vehicle producer, understands the implications immediately. These companies are not waiting for commercial rollout to secure supply. They are quietly accumulating silver years ahead of mass production. This is not speculative hoarding, but strategic inventory planning. Electric vehicle manufacturers cannot afford production delays caused by metal shortages. When battery supply chains fail, entire factories shut down. For executives, silver availability now ranks alongside lithium and rare earth elements. This demand is price inelastic because silver cost is negligible relative to vehicle value. Even at much higher prices, silver remains a small fraction of total manufacturing cost. As a result, rising prices do not reduce demand. Instead, higher prices reinforce the urgency to secure supply early. This behavior mirrors historical commodity hoarding cycles before major shortages. Solar and electric vehicles are now competing directly for the same physical metal. The global silver market was never designed to handle both at full scale simultaneously. That mismatch sets the stage for inventory depletion and extreme price repricing. As demand accelerates, the most revealing data appears in exchange inventories, where physical silver availability can no longer hide. Warehouse stocks at the Shanghai Futures Exchange have collapsed over the past several years. Inventories that once exceeded thousands of tons are now a fraction of their former size. More alarming is the registered category, the metal available for immediate delivery, which is nearing exhaustion. When registered inventory disappears, futures contracts lose credibility. This is why China's silver market has entered backwardation. Backwardation means buyers are willing to pay more today than for future delivery. It is a classic signal of physical shortage. Factories are effectively saying they do not trust future promises. They demand metal now or risk shutting down production. This condition almost never appears in stable commodity markets. When it does, it precedes violent repricing. While China experiences backwardation, Western traders focus on charts and indicators. They trade silver as a currency proxy, not an industrial input. This disconnect leaves Western markets dangerously misinformed. Paper selling continues in New York despite mounting physical stress. Each paper sale transfers more metal from west to east. This flow represents a silent wealth transfer through mispricing. Physical silver leaving Western vaults is unlikely to return. Once inventory drains, paper markets are left exposed. This inventory drain explains why arbitrage has failed despite what appears to be free money on the surface. Banks cannot move silver that no longer exists in deliverable form. Logistics have become the choke point in a system built on assumptions of abundance. Vault operators now speak of delays to locate specific bars. In a digitized vault system, delays imply stress or rehypothecation. Refineries are reporting weeks-long backlogs for new metal processing. These bottlenecks confirm physical scarcity, not temporary disruption. Western institutions are discovering the limits of paper leverage. The illusion of infinite supply collapses once delivery is demanded. This is why the arbitrage gap keeps widening instead of closing. Every attempt to exploit the gap accelerates inventory depletion. That creates a feedback loop where scarcity feeds higher prices. Meanwhile, the calendar amplifies risk as markets enter holiday liquidity drought. During low-volume periods, prices adjust violently to new information. Thin order books magnify even modest buying pressure. When algorithms detect mispricing, they respond instantly and without judgment. Humans normally restrain machines during unstable conditions. But during holidays, oversight is minimal and automation dominates. This sets the stage for abrupt price gaps rather than gradual moves. Once triggered, such gaps are difficult to stop or reverse. When the price gap finally reacts, it will not move smoothly, but violently, because liquidity cannot absorb the adjustment. The first trigger will likely be a single large industrial buy order entering a thin market. With few sellers present, prices will jump multiple levels almost instantly. Algorithms will detect the movement and amplify it through automated arbitrage logic. This creates an air pocket where prices gap higher without resistance. Once key price levels are breached, options positioning adds fuel to the move. Banks that sold call options must hedge by buying futures. Their buying pressure accelerates the upward move even further. This feedback loop forces banks to chase the market they once controlled. At that point, price suppression becomes impossible. Any attempt to cap prices risks immediate loss of physical inventory. The paper market is forced to reprice toward the physical reality. When New York approaches the Shanghai price, skeptics will call it a bubble. But this repricing is not excess, it is correction. $80 is not the peak, it is the floor. Once confidence breaks, industrial buyers shift from just-in-time to just-in-case. This change permanently raises baseline demand. Supply cannot respond quickly enough to offset this shift. The result is sustained price discovery rather than a temporary spike. The silver market enters a new regime defined by scarcity. For investors, the greatest risk now is not price volatility, but psychological error. Years of suppressed pricing have conditioned people to believe silver cannot stay high. That mental anchor becomes dangerous during regime shifts. Selling physical silver for depreciating currency at this moment is a strategic mistake. The relevant metric is no longer dollars, but purchasing power. Gold to silver ratios reveal silver remains historically undervalued. Until that ratio compresses dramatically, the bull market is unfinished. Short-term paper crashes should be treated as noise, not signals. Physical premiums will remain elevated regardless of screen prices. When inventories vanish, the quoted price becomes irrelevant. The priority is securing ounces, not timing dips. Once retail shortages appear, access disappears overnight. At that point, price discovery accelerates without participation. This transition marks the end of Western paper dominance. Pricing power is shifting toward physical markets and industrial demand. Silver is reasserting itself as a strategic material. The coming years will redefine how real assets are valued. What appears chaotic now is the system correcting decades of distortion. Those who understand this shift position early and patiently, history will remember this moment as the end of the paper-silver era.